Welcome to FX Tech. In this week's analysis, we're dissecting the AUD/USD pair for the period of December 15th to 19th, 2025. After a strong 3-week rally, the Aussie dollar's momentum began to fade. We'll explore the key drivers behind this shift, from disappointing labor data in Australia to the deteriorating risk sentiment in global markets. We'll break down the technical levels, provide our short and mid-term outlook, and outline a clear trading strategy to navigate the year-end volatility. Stay tuned for a comprehensive breakdown. This week, the AUD/USD's bullish run hit a wall. The pair closed lower after touching 0.6685, making it the third worst performing G10 currency. A critical spinning top doji formed on the weekly chart, signaling significant indecision and potential exhaustion after the recent rally. The failure to break the key September high of 0.6706 has reinforced this level as a formidable resistance zone. While the week closed with a gain, bearish momentum indicators suggest that the upward trend is losing steam. The primary catalyst for the Aussie's weakness was a disappointing labor market report. This has significantly cooled speculation of a potential RBA rate hike in 2026. As a result, the market is rapidly repricing its expectations. The RBA's rhetoric has shifted away from discussing hikes, now focusing strictly on data dependency. This erodes a key fundamental support for the AUD, which was the policy divergence between a hawkish RBA and a dovish FED. Global risk sentiment took a nosedive, dragging the Aussie down with it. The AUD/USD fell to a 2-week low as U.S. equity markets sank, driven by year-end profit-taking and concerns over tech valuations, particularly in the AI sector, following the Gemini 3.0 release. The high correlation between AUD/USD and the S&P 500, which stands between 0.7 and 0.9, amplified these downside moves. For now, broad risk-on/risk-off dynamics are overshadowing Australia's domestic fundamentals. Across the Pacific, the Federal Reserve delivered its expected 25 basis point rate cut. However, the decision was marked by rare dissent, with 3 FOMC members disagreeing, highlighting internal division and uncertainty. This has shifted the market's entire focus to incoming U.S. data, with NFP, retail sales, and inflation reports becoming critical. Adding to the mix, speculation about Kevin Warsh becoming the next Fed chair triggered a notable jump in U.S. 10-year yields, further complicating the outlook for the dollar. China's economic struggles continue to be a persistent drag on the Australian dollar. Persistently weak retail sales and the ongoing housing crisis are undermining the AUD's strength. Government pledges to spur consumer spending have yet to translate into meaningful action, dampening demand for Australian exports. This also puts pressure on commodity prices, a key driver for the Aussie. The lingering threat of U.S.-China trade tensions remains a significant, albeit dormant, risk factor for the currency. From a technical standpoint, the AUD/USD is consolidating within a broad range between 0.6400 and 0.6700. The pair is currently retreating from the top of this range. Key resistance is firmly established at the September high of 0.6706 and the October 2024 volume profile point of control at 0.6728. On the downside, support is found at the October high of 0.6617, the psychological 0.6600 level, and an immediate floor at 0.6580. The market is now waiting for a definitive catalyst to break this multi-month structure. For the next 1 to 2 weeks, our outlook is neutral to mildly bearish. We anticipate a target range between 0.6580 and 0.6670. This view is supported by historical seasonality, as the December 15th to 19th period is typically negative for the AUD/USD. Furthermore, the fading bullish momentum suggests a period of consolidation or a slight pullback is likely. We expect a more bullish bias to re-emerge from December 20th onwards, heading into the end of the year. Over the next 1 to 3 months, our outlook is cautiously bullish, with a 60% probability of reaching a target range of 0.6650 to 0.6800. This scenario depends on a continued dovish pivot from the Fed and stable global risk sentiment. Any positive stimulus surprises from China would provide an additional tailwind. However, there is a 40% downside risk of a drop to the 0.6350 to 0.650 range if U.S. inflation resurges and forces the Fed to adopt a more hawkish stance. To summarize, the key risks are a resurgence in U.S. inflation, a continued lack of stimulus from China, and any escalation in geopolitical tensions. Our recommended strategy is to look for opportunities to buy on dips near the 0.6580 to 0.6600 support zone. Consider adding to long positions on a confirmed daily close above the 0.6706 resistance. Crucially, maintain tight stop-loss orders below 0.6550 to effectively manage risk and protect your capital in this uncertain market.